Welcome to our channel, where we explore the exciting world of finance. In today's video, we're going to take a deep dive into the world of stock market investing and provide a beginner's guide for those interested in getting started. We'll explain what stocks are, how to research and choose stocks, the types of stocks available and the risk and reward associated with investing in stocks. So, let's get started. Stocks, also known as equities, represent a share of ownership in a company. When you buy a stock, you own a small piece of that company and are entitled to a share of its profits and assets. The stock market is where stocks are bought and sold, and it's a great way to invest your money and potentially earn a return. The first step in stock market investing is researching and choosing stocks. This can be done through analyzing a company's financial statements, such as its balance sheet, income statement, and cash flow statement. These documents will give you an idea of a company's financial health and its potential for growth. You can also look at the company's management team, its industry and market conditions, and its competitors. Additionally, you can check the company's PE ratio, price to earnings ratio, which compares a company's stock price to its earnings per share. A low PE ratio may indicate that a company is undervalued, while a high PE ratio may indicate that a company is overvalued. There are also stock market indices, such as the S&P 500, which can be used as a benchmark for the overall performance of the stock market. For example, if you want to invest in a particular sector of the market, instead of picking individual stocks, you can invest in an ETF, exchange-traded fund, that tracks an index of that sector. There are two main types of stocks: growth stocks and value stocks. Growth stocks are companies that are expected to grow at a faster rate than the overall market. These companies often reinvest their earnings back into the business to fuel growth. They tend to have a high PE ratio, and the investors are willing to pay more for the stock now, expecting future growth. An example of a growth stock would be a technology company like Amazon or Tesla. Value stocks are companies that are undervalued by the market and have a lower price-to-earnings ratio than growth stocks. Value investors believe that these companies are currently underpriced and have potential for appreciation in the future. They are often companies with a long history of paying dividends and have a consistent financial performance. An example of a value stock would be a utility company like Duke Energy. Investing in stocks carries risk, as the value of a stock can go up or down. The value of a stock is affected by a variety of factors, including the performance of the company, the overall state of the economy, and market conditions. However, over the long term, stocks have historically provided higher returns than other types of investments such as bonds or savings accounts. It's important to diversify your portfolio by investing in multiple stocks and not putting all your eggs in one basket. This way, even if one stock performs poorly, it will not significantly impact your overall portfolio. To reduce risk, it's also a good idea to spread out your investments over time, rather than investing a large sum all at once. Stock market investing can be a great way to grow your wealth over time, but it's important to do your research, diversify your portfolio, be aware of the risks involved, and have a long-term perspective. Thanks for watching. Don't forget to like, comment, and subscribe for more videos on finance and investing.